Hey, what's going on, guys? SmartHelping.com here. I'm Jay, and we're going to go over the product as a service model. It's a really awesome template. I put a lot of work into this. It's one of the best things I've ever built. I'm going to go through all the assumption tabs for you. Don't forget to like the video, subscribe to the channel. I live stream on the weekdays at 10 a.m. Eastern. Check it out. I built this all on the live stream. Um, if you want to buy the template, it'll be a link in the description box below. And what I'll do here is give you an overview of the template and how every tab works. So the first tab, global control here, we're just going to define some assumptions about the product as a service model or business. And actually, before we get into it, product as a service simply means you're acquiring manufacturing products, and instead of directly selling them, you're selling a subscription to them or to the benefit of them. So it shifts a little bit the business model of the business is from thinking about margins of products and rather the value you can get from reselling the benefits the products give. This topic's been well researched since the early 90s, but more recently we've seen this model implemented in new types of businesses that it hasn't been. So it's gaining a little traction, and so I've built a model here, product as a service, and let's get into it. So the main tab here, these are like the global assumptions. We're defining the name of the company, the launch year, and remember if you change the launch year, adjust any necessary drop downs. You'll have drop downs on the subscription revenue tab, on the running costs tab, debt schedule, and a little bit on the CapEx here. So make sure to update those dates if you do change the launch year accordingly. Then we've got the end month here. So on the end month, you can define the template to end on any month over a 10-year period. Whatever you pick to end, operations will stop, and then you could choose to use a terminal value or not. If yes, it'll take a multiple of the 12-month trailing revenue as your evaluation basis. You can also select no if you don't want to show that value. The main reason it's there is for discounted cash flow analysis, but you don't have to show it if you don't want to. Next, we have cash sources. So here, debt funding, 250,000. This is an arbitrary number I just put in. The model will solve based on all your startup costs, any burn, the CapEx. It'll solve for the minimum cash required in order to keep the cash balance above zero. And that will be after any traditional debt sources. You've also got some tax rates here. If you want to see after-tax cash flow, you will be able to. And then we've got all our sanity checks right on the front here. Now, as we go, the most important part of the whole model is probably the build-out tab. This is some of the most interesting logic I've ever done. So let's just go through it by column. Column B, well, column A is the date of the purchase or manufacturing or when the product is finished being manufactured and ready to go live. And so this date lookup here is based on the month entered here. So column B is just the name of the tranche, and you could do up to 120 or 170 tranches of product installments. And these are the products you're selling a service to. So you can define any naming there, the month that it happens, so month 1 through 120. You can define the month there and the unit count that's going live on that month here. Now, based on these two inputs and your useful life, you'll have an available capacity based on the maximum minutes a unit can be used for per month. So this model's, I try to figure out the least common denominator between, how does the model make sure there's not too many customers for how many products there are? And in generally, I said, okay, well, we can define a maximum minutes a unit can be used for per month, and then how many average minutes a customer will use a product for per month, and there's your capacity measure. So you can define the maximum minutes a unit can be used for here per month, and then based on the useful life and unit counts online, you'll see this is the available minutes that are available to use. And then we'll get into the subscriber side of it, but the subscriber assumptions will result in a demanded minutes used by customers, and then you can compare those, and this will automatically tell you how much of the capacity you have available is being used over time on a 120-month schedule of its own. So obviously this can't go over 100% or else you've defined assumptions that result in too many customers and you don't have enough products for them to be using based on the minute usage assumptions. So that you've also got the cost per unit here and total cost here. So this is going to be CapEx that you're spending in order to get these products to be available to use. And so this schedule will kind of launch when you're going to want to match this up, these month numbers here, with when you start the subscription service here. So this month is going to drive when customers start coming online. Now that's a good segue. So the next tab is subscription revenue. You define the month customers come online. And there's a couple acquisition channels. There's ad spend and some cost per acquisition. And then based on that, you've got some amount of customers added per month over 10-year period. You've also got organic customers, so the starting customers added per month, and then the increase of customers added per month as a percentage. It's a monthly compounding increase rate that you can define in 10 years. So these two assumptions will define how many customers you have over time, and then based on that, you have up to 3 pricing tiers that customers can pay to use the products that you have that you put in the build out here, and they could pay. Here I just put 15, 25, 35, increase the price a little bit in year 2, and stabilized. This will be based on your own pricing strategies, but you can see what the economics look like when customers are paying a certain amount, and then you have to build out the products. You can define the percentage of customers that fall into each tier, and also the average minutes used per month per customer of the products that you're offering. You've also got an average life of the customer. So this is an amount you can put in years, and it can be a decimal. If it's like 6 months, you can put 0.5 here, and that's completely fine. And this just gives you a resulting monthly churn, and this will define all the retention of each monthly cohort of customers that join. So we're using best in practice retention logic to define how many customers exist over time. Uh, the next part of this is direct sales. So on direct sales, you can also do up to 176 purchase tranches. You can define the month that they're purchased. You can define the unit count, how many you're buying or manufacturing, the cost per unit, total cost per cohort, and then how much you're going to sell each unit for here. And then based on this schedule here, you can define the percentage of supply sold per month. For example, if I had 50 units produced here, I'm saying 0% are sold after 1 month, 0% after 2 months, and then month 3 I sell a quarter, a quarter, quarter, quarter. So this gives you the option to do offsets. It's a little bit of planning for inventory, how much inventory you're going to have, the value of it, how much you're going to sell, and what your margins are. And again, this is done so you can compare, well, what if I do the product as a service model? What's that look like? Or what if I zero all this out and do direct sales? What does that look like? Or some combination. And you'll see all this on the income statement in the balance sheet, and all the monthly detail and everything else just flows through automatically. Running costs here, you can find just general operating expenses. I've got sales and marketing, general administrative, research and development, and some costs as a function of monthly sales of subscription revenue and direct sales. This is like a catch-all. You can also define if you have any cost of goods sold directly related to the amount of active customers in each tier per month, and what that cost is per customer per month. And you could also define the start month of each of these fixed costs. And sales and marketing is going to be a pretty big one here. And especially if you're acquiring new customers, there's going to be a lifetime value. There's going to be customer acquisition cost metrics. So this is a really important section. Debt schedule, this is just a regular amortization based on any debt used to fund any of the startup costs. You can define the terms here and the start month, and that's just a regular schedule. And if you do decide to include terminal value, any debt remaining at the end of the forecasted period will be repaid, and that will reflect in cash flow. Cap table, so here we're going to define, we see the minimum equity needed to keep cash above 0. Shares, I just did 100% as common shares in this example. You could define the funds contributed. Row 30 is an overflow of any remaining funds that haven't been contributed by any outside investors or inside investors. You've also got the percentage of common stock that's given to each of these either outside or inside investors. And then you can see the resulting 10-year summary for each individual and aggregate of their initial investment, any distributions over time, and the IRR of that. CapEx, so the top 6 sections are for fixed expenses that are not your products that you're essentially selling a subscription service to use. So these could be like just other equipment, machinery, a building. You just define the cost basis here, the useful life, and the month of expenditure. That'll all populate. And then for the building separately, you can define any value if any at sale. The rest of this is all formulas to figure out depreciation on the income statement and um, some tax calculations on net gain or loss if you're going to include taxes. Startup costs, these are any other one-time costs that happen before the um, business actually begins operations, and you still need to account for some costs here and initial equity that might be required. You can also put a reserve here. This reserve would then show you if you had a zero cash balance, technically you still have whatever was put into the reserve available. Terminal value, we're just saying based on the total value of at exit, how much percentage of that's going to go towards fixed assets versus the actual business set or the extraordinary income. This is just something for taxes. If you don't want to worry about it, just put 100% here. Income statement, we now see here's our subscription revenue over time based on all those different assumptions. Here's our direct sales revenue over time, and you can see this goes out for 10 years. We have our total revenue. We have cost of goods sold for the subscription service. We have cost of goods sold for direct sales here. Gross profit. We have our general administrative costs, sales and marketing, research and development costs, startup costs, OPEX. Then we have EBITDA as a result of your total gross profit less OPEX. Then we've got some interest, if any, from the debt. We've got depreciation on all the fixed assets, which this would be the product as a service portion of what you're selling a service to. So you got depreciation expenses there rather than in the direct sales model, you'll have cost of goods sold here for that. And then we've got taxable income and net income. And you can see on the exit here, it's the exit month. If you include terminal value, you can see a big bump there. Annual income statement, same deal, but on an annual basis. All the same numbers. We got our check balance there. Balance sheet. So here's the interesting part. You can see on a monthly basis, here's the cash balance. You can see we solve for 0. If you go over there, we never go below 0, but we solve for 0. That's what the model's solving for. And here's the balance over time. Here's the inventory over time based on direct sales assumptions and how long it takes to sell and when units are produced and available in inventory. Here's the fixed assets for the product as a service portion. Here's the accumulated depreciation. If we go down, we've got debt, equity, and retained earnings. And then we've got down here assets equal liabilities plus owner's equity and the check. So this all works. You can change the assumptions to anything you want, and all this will update automatically. Balance sheet annual, same thing, but on an annual basis. Here's a check on those. Cash flow statement, you can see cash flow from operating activities, investing activities, financing activities. We've got our customer receipts, OPEX, payments for interest tax. Here's our capital expenditure, sale proceeds, sale depreciable assets, borrowing of debt, principal repayments, sale company stock coming in. Now on this, we can see the CapEx is going to be including your purchase of products as well as the purchase of products for direct sales. So those are going to be both in that row over time. We've also got cash flow statement annual that gives you an annual summary of everything that's going on. Now remember here, depreciation is a non-cash item, so it doesn't show up on the cash flow statement. We don't need to add it back because we're not reducing it in net income at the top. We're actually breaking out the main items of the income statement here that are cash items. And so other OPEX in this case is summing up. If you look on the monthly, it's summing up row 27 and 15 from the income statement, which is the subscription cost of goods sold and the total OPEX, but it's not summing up these direct costs of goods sold for selling things because those costs are actually going to hit in this row here, and you don't want to double count. So there's that. You've got visualizations, lots of visualizations. So total revenue by year, EBITDA by year, monthly cumulative cash flow. This is nice. It shows you when the equity break even happens based on all the different cash flow items. So here you can see the minimum cash positions, what we need, and then we start to make some money here, and we finally pay back the equity on, in this case, around July 2026. You've got revenue by sales channel. So this is direct sales versus subscription revenue. You've got capacity usage. So this is that first on the build out assumptions area where we can see how much are the customers demanding in product usage versus how much usage is there, which would be the 100% line. And we're getting up to that, but we never pass it, so that's good. Monthly revenue by subscription tier. Here you can see just a monthly amount earned for the product as a service portion. And then we have our advanced metrics for the recurring revenue. So customer acquisition cost, average length of time a customer is active in months, gross profit per customer per month, average customer lifetime value to CAC ratio, and months to repay CAC. So some very important metrics there. Executive summary, you can see high level total units available over time. This is going to show based on your build out assumptions here and any useful life, how much is available over time, the total sales from selling subscription to those units, the direct sales revenue, total revenue, your cost of goods sold for each of the different sales channels, total cost of goods sold, gross profit, your general operating expenses, other operating expenses as a percentage of revenues, total expenses, and then we get down to EBITDA. We have debt service coverage ratio as well, percentage of EBITDA margin, and then we have other cash flow items, and you can see a whole view of how we get down to cash flow per period. And we've also got IRR, ROI, and equity multiple for the project as a whole, as well as for the investor and the owner. You've also got some revenue and EBITDA assumptions here by year. We go over here, distributions. This is just kind of cash flow analysis. So this is showing, and let's extend this out for 10 years. IRR for the whole project, IRR for the investor group, IRR for the owner group here. And this is just showing you how much equity was initially contributed and then what cash flows are available after any burn that happens. And this total here will always match the ending cash position. All right, so IRR, you can define a discount rate on each of these sections, and then that'll get you to net present value of each for the project and investor and owner side. I've also got a visualization for cash flow. The monthly detail is going to show you I broke it into sections. You've got the PaaS portion up here, which is labeled on the left-hand side. This is the total purchase of units that you're going to sell subscription to, the cost of that, your total customer counts over time, the percentage of those customers that are tier 1, 2, and 3, your subscription revenue, product usage, cost of goods sold for the subscription, and then gross profit on the subscription side of things. Then you've got direct sales as its own separate area, the cost of those items, direct sales, units sold, revenue from direct sales, cost of goods sold, and gross profit from direct sales. So those are two separate sections. You can really see how they happen there and what the economics look like. Then here's a summary of basically everything above. Total revenue, total cost of goods sold, gross profit. Then we have all our running operating expenses, percentage of cost as a percentage of subscription revenue, total OPEX, EBITDA, and then all these other cash flow items. So you're adding back cost of goods sold here, reducing out CapEx. You've got taxes, exit proceeds, debt service, startup costs, and debt proceeds. And after adding all of those together with EBITDA, you then have cash flow. And then we've got advanced metrics down here. Annual detail, same deal, but on an annual basis. Otherwise, the same things happening here. And then this balances out with the monthly check there. Overall, this model is really, really comprehensive. It's awesome. All the logic happens in these matrix tabs here, these 3 matrix tabs. You can learn more on that if you want to look at the live streams, but this is how everything kind of is able to happen like it is. And that's all I got for you. So check out the model. Again, one-time fee of $75, and you can play around with this thing. It's really great at forecasting cash flow, looking at the unit economics of doing a product as a service business. I'll see you guys on the next one.